All right, so let's have a heart-to-heart and be honest about your portfolio. Now, so far, I know 2022 has not been a good year for the stock market, and there have been more red days than green days, and every bit of good news received is followed by what seems like an avalanche of sell-offs, no doubt fueled by uncertainty and fears of inflation. Just look at the stock charts, for example. If you look at the year-to-date chart, the Dow is down, the S&P is down, I believe, by almost 10%. And let's not even get started on our good old pal, the NASDAQ. I mean, the NASDAQ is just getting absolutely annihilated so far in 2022, down over 13% at the time of recording this video. So we can say comfortably that it's smack in the middle of correction territory. Now, while all this talk of record inflation numbers and rising interest rates have dominated the news and are on investors' minds, and rightfully so, there's another alarming bit of info that's starting to pick up steam, and that is talk of a recession. Now, no one even thought of mentioning the word recession during the market recovery, but here we are in 2022, and there are indeed legit fears about a recession. I will get into it, but before we do, please drop a like down below, as it does help out the channel, and also lets me know what sort of videos you like, so I can give you more of that. With that said, let's get right into it. So like I said before, the economy is still reeling from the effects of the pandemic, and there have been signs of recovery, albeit at a gradual pace. And we're also seeing the effect on the stock market. Most of the gains in 2021 have been reversed so far in 2022 due to inflation and interest rate fears. Now, stocks sold off following the news that inflation reached 7.5%, which is its highest level in 4 decades. Now, the yield on a benchmark 10-year US Treasury, which moves inversely to prices, shot above 2% for the first time since 2019. It was close to 1.5% at the end of last year. Now, this is important because it shows that a Treasury yield curve has been flattening over the past few months. And before you ask, well, what in the world does this even mean? Let's go over that right now. Now, the US Treasury finances government obligations by using various forms of debt, similar to how corporations take on debt to finance growth. So you can kind of think of it in this manner. So the government issues debt contracts with a term and a guaranteed return based on the interest rate. And these debt contracts come in the form of Treasury bills with a 1 to 12 month maturity, notes with a 2 to 10 year maturity, as well as 20 to 30 year bonds. Now, the shape of the Treasury yield curve is a key metric that Wall Street analysts monitor, as it impacts asset prices, bank returns, and even serves as an indicator on how the economy will perform. And the yield curve plots the yield of all the Treasury securities that I just mentioned. Typically, the curve slopes upwards because investors want to be compensated more for taking on the risk that inflation will lower the return of owning longer dated bonds. Now, because of this, a 10-year note will typically yield more than a 2-year note because it has a longer duration. Now, a steepening upward curve usually indicates expectations of strong economic activity, higher inflation, and higher interest rates. A flattening curve means that investors expect interest rate hikes and have generally lost confidence in the growth of the economy. And an inverse curve is basically the worst case scenario, which we'll touch on in a second. But first, let's look at what's currently going on with the yield on the 2-year Treasury. Now, the 2-year yield has actually gained about 110% in 2022 and now sits above 1.5%. Now, if that number sounds familiar, it's also because, as mentioned earlier, it is also approximately where the 10-year Treasury yield sits. Now, typically investors demand higher payouts on longer dated bonds since it's harder to predict risk. So the yield on a 10-year bond will be higher than the yield on a 2-year bond, for example. Now, what we now see with the 2-year yield and the 10-year yield being at approximately the same point results in a difference between the two approaching zero. And this is specifically what's raising alarm bells and a worst case scenario. Speaking of worst case scenario, now is probably a good time to talk about the inverse yield curve. Now, when the difference between the 2-year and the 10-year yield is a negative value, the curve goes on a downward slope and eventually results in what's known as an inverse curve. Now, this inversion in basic terms essentially means that the long-term bonds are worthless as they hold less value over time compared to a shorter-term bond. Now, since 1955, the inverting of the yield curve has historically preceded a recession without fail, with a recession occurring approximately 6 to 24 months later. And the fact that we're seeing this flattening right now is a strong indicator that we could be heading into the initial stages of a recession. So the question is, how did we get here? Well, this all stems from the government's battle to curb inflation. Anyone remember Jerome Powell's insistence that inflation was transitory and not persistent? Remember that? Well, that turned out to be incorrect. Now, many people blame the Fed's accommodating approach to the low interest rate environment, as well as not recognizing the threat of inflation and starting the tapering process sooner. So basically, if they started the program of tapering the bond purchases earlier than they actually did, people are saying that we probably wouldn't be in this situation. Now, are they right? We'll never know, but it is what it is at this point. Right now, the Fed is seen as playing catch up, and the aggressive forecast for multiple interest rate hikes this year has many experts raising risks about impacts to the market and the economy. So the Fed is playing a delicate game, which basically breaks down to this. Interest rates have an impact to everything from mortgages to the amount of money to what businesses can borrow to expand your operations. Now, if the rates are pushed higher than actually what's affordable, or if there's a sharp spike, the spending could stop, which means that people may not be able to afford that house loan or that car loan, or companies could actually resort to laying people off instead of being able to borrow more money to finance your operations. Now, if rates are not pushed aggressively enough, we get a high inflationary environment, which results in a rapid decline in the value of money. So a dollar today will be worth less as each day passes. Now, one thing we know for sure, without a doubt, is that there will be interest rate hikes. We're at that point where that's inevitable, so there's no point in even arguing or debating that point. Now, what's left to be determined is how frequent and by how many points the interest rates will rise. We're going to get an idea of that at the end of the March Federal Market Open Committee meeting. But I believe that there are several things that can be done to be in a better position financially during the upcoming period of uncertainty. First off, it's going to be important to pay attention to the minutes from the next Federal Market Open Committee meeting. Now, this is going to have a strong impact to how the market and the general economy reacts. So I'll leave a link in the description for where to look for those minutes. Secondly, I'll look for any opportunity to refinance any open debt. So this could be refinancing a mortgage, refinancing your car payments. Obviously, it would be better to do this in a low interest rate environment. So if we head into a recession, this is probably what we'll see in the short term. Now, refinancing reduces the amount of your monthly payments as well as the interest that's being paid on the loan. Also, I would probably ensure that I have enough cash on hand to deploy. Now, I think this is important because it's prudent to be ready to jump on any investment opportunities. Now, a lot of wealth is actually created in a down market, as it gives the opportunity for investors to capitalize on depressed prices and set up for greater gains in the market recovery. And then the last point I'd like to mention is to probably continue a dollar cost average into my investment positions. And this will mainly be with defensive, recession-proof companies. Now, a dollar cost averaging strategy ensures that you not only take advantage of the depressed market, but that you also get a chance to participate in the upswing. And when that happens, you don't have to worry about timing the market. Now, these are just things that I would do. And it's my opinion because, this isn't financial advice. If you would like to get started investing, Wealthsimple Trade is a great brokerage to use as they offer commission-free investing, meaning that you do not have to pay any commissions on any trade. And if you use my link below, you get 2 free stocks. Yep. 2 free stocks using the link below, so check it out. But anyway, with that said, I'll end it here. I hope you found this video insightful. Please check out the links below again, and I hope they help you out. Once again, thanks for watching, and I'll catch you in the next video.